If you observe carefully the history of financial markets, you'll notice a pattern that repeats with almost mathematical precision. Every 5 to 10 years, millions of people make exactly the same mistake. A mistake so basic it seems impossible to happen. And yet, it happens repeatedly. In 2026, this mistake will cost more than ever before. This isn't a prediction. It's a logical consequence of the cycles that govern our economy. And the place where most people are keeping their money right now is precisely where you shouldn't leave a single penny in 2026. Let me be direct with you. The worst place to keep your money in 2026 is traditional savings accounts and low-yield fixed income products. And this isn't an opinion. It's pure mathematics combined with the economic cycles we're experiencing. Over the next 40 minutes, I'll explain exactly why this is happening, how long-term cycles are converging to create this situation, and most importantly, what you should do about it. But first, I need you to understand something fundamental about how money really works. History is an excellent teacher, and it teaches us that the same patterns repeat constantly. Let me show you 3 historical moments that perfectly illustrate what's happening now. In 1970, the savings rate in the United States was paying about 4.5% per year. It seemed like an excellent option. Safe, government guaranteed, without volatility. Millions of Americans kept their savings there, confident they were doing the right thing. But there was a problem that few noticed at the time. Inflation was beginning to rise. In 1974, it reached 11%. In 1979, it hit 13.5%. Meanwhile, savings accounts were paying between 5% and 6%, well below real inflation. The result? Anyone who kept their money in savings during that decade lost approximately 30% of their real purchasing power. Not because the nominal value decreased, but because inflation silently eroded the purchasing power of that money. In Japan, in the 1,990 seconds, we had an even more dramatic example. After the real estate and stock bubble burst in 1991, the Japanese government kept interest rates near zero for decades. Those who kept their money in savings accounts and bank deposits saw their resources literally wither away, not just from inflation, but from silent deflation, a stagnant economy where idle money lost any and all real return. Between 1990 and 2010, those who kept money in savings in Japan had negative real returns for 2 consecutive decades. 2 entire decades where the safest place was actually the most dangerous place for long-term wealth. In 2008, when the financial system almost collapsed, something interesting happened. People rushed to savings accounts thinking it was the safest place. And technically, it was safe in the short term. But what few anticipated was the central bank's response. The Federal Reserve lowered rates to near zero and kept them there for 7 years. Those who stayed in savings for safety saw their money earn practically nothing while the economy recovered and real assets appreciated. Between 2009 and 2016, while savings yielded less than 1% per year, the S&P 500 index rose more than 200%. Real estate in many regions appreciated 40% to 60%. Commodities had significant upward cycles. The pattern is always the same. In moments of uncertainty, people rush to what seems safest. But this apparent safety hides the greatest risk of all, the risk of lost opportunity and silent erosion of purchasing power. To understand why 2026 will be particularly dangerous for those who leave money idle, you need to understand 3 fundamental principles that govern all financial markets. We live in a credit-based economy. This means economic growth is fundamentally linked to the ability to create and expand debt. When debt grows faster than income, we have periods of expansion. When debt stops growing or needs to be reduced, we have contractions. Right now, we're in a very specific phase of this cycle. After 15 years of ultra-expansive monetary policy with rates near zero and trillions of dollars created by central banks, we've reached a turning point. the total debt of the United States government, businesses, and families is at historically high levels. This creates a dilemma. Either we continue expanding the money supply, causing inflation, or we contract, causing asset deflation. There's no sustainable middle ground. In either scenario, keeping money in low-yield instruments is a losing strategy. If we have inflation, you lose purchasing power. If we have asset deflation, you lose opportunities to buy at low prices. There's a fundamental difference between nominal security and real security. Nominal security is the guarantee that you'll receive the same number of dollars you deposited. Real security is the guarantee that those dollars will maintain the same purchasing power over time. Savings accounts offer nominal security, but not real security. When you deposit $10,000 in savings that pays 2% per year, you're guaranteed to receive your $10,000 back plus $200 in interest. That's nominal security. But if inflation is at 4% during that period, the real purchasing power of your $10,200 will be less than the original $10,000. You earned $200 nominally, but lost approximately $200 in real terms. Net result, loss of purchasing power. This is the type of security that silently destroys wealth over the years. It's a comfortable illusion that costs dearly for those who believe in it. The third principle is perhaps the most important and least understood: compounded opportunity cost. This is the invisible cost of not investing in assets that appreciate over time. Imagine two people in 1990. Both had $50,000 to invest. The first kept everything in savings, which paid approximately 4% per year. The second diversified, 40% in stocks, 30% in real estate, 20% in commodities, and only 10% in low-risk instruments. After 35 years, in 2025, the first person would have approximately $200,000. Seems like a good return, right? But the second person, who accepted more volatility in exchange for potentially higher returns, would have something close to $800,000. The difference, $600,000, is the compounded opportunity cost of seeking the safety of savings. It's the price of avoiding short-term risks while accepting the much greater risk of long-term impoverishment. If you understand incentives, you understand behavior. The incentive of financial institutions is to make you believe that low-yield products are safe. The real incentive should be to preserve and grow your purchasing power over time. Let me show you three concrete scenarios that illustrate exactly why 2026 will be particularly dangerous for those keeping money in low-yield instruments. Imagine a 8-year-old couple with $500,000 saved for retirement. They're nervous about market volatility and decide to keep 80% of their money in CDs, certificates of deposit, paying 3.5% per year. It's safer, they think. At least we don't lose money. But let's do the real math. If average inflation is 4% per year, and there are good reasons to believe it will be at least that, they'll lose 0.5% of purchasing power annually. It seems small, but over 7 years until they retire, this represents a real loss of approximately $35,000 in purchasing power. Worse still, they miss the opportunity to have exposure to assets that historically outpace inflation. If they had allocated 60% to a diversified portfolio of stocks and real assets, keeping 40% in more conservative instruments, they probably would have had at least $100,000 to $150,000 more when retiring. The safety cost between $135,000 and $185,000, that's a very high price to pay for the illusion that they were protected. Now consider a 8-year-old professional who managed to save $75,000. He heard about market volatility and decides to keep everything in a high-yield savings account that pays 2.8% per year, waiting for the right moment to invest. If he maintains this strategy for the next 37 years until retirement and manages to add $500 per month to savings, he'll have accumulated approximately $550,000 at age 65. Again, it seems like a respectable number, but if he had invested the same amount in a diversified portfolio yielding 7% per year, which is close to the long-term historical average of the stock market, he would have more than $1.8 million at the 65. The difference, $1.25 million. That's the cost of 37 years waiting for the right moment and seeking the safety of savings. It's the difference between a comfortable retirement and a truly prosperous retirement. Imagine a medium-sized family business that maintains $2 million in cash reserves. The owner, wanting to preserve capital, keeps everything in short-term government bonds paying 3.2% per year. It's company money. He justifies. I can't afford to lose it. But this mentality completely ignores opportunity cost and inflationary erosion. With inflation at 4% per year, this company is losing $16,000 in purchasing power annually just on these reserves. If it maintained 70% in conservative instruments and 30% in a diversified portfolio of real assets, commercial real estate, commodities, infrastructure company, stocks, it would probably better preserve value while still having sufficient liquidity for operations. Extreme conservatism, in this case, is actually the riskiest strategy for long-term capital preservation. Now that you understand the principles and have seen concrete examples, let's talk about what this means specifically for your financial situation in 2026. The year 2026 marks the convergence of several important economic cycles. First, we'll be completing almost 18 years since the 2008 financial crisis. Historically, major market corrections tend to happen in cycles of 15 to 20 years. Second, American public debt will be reaching levels that will force difficult decisions about fiscal and monetary policy. The government will have to choose between allowing higher inflation or accepting significant economic contraction. Third, the demographic transition, with millions of baby boomers retiring, will create additional pressures on the financial and pension system. This will affect both interest rates and demand for different types of assets. In any of these scenarios, keeping money in instruments that neither keep up with inflation nor offer exposure to real assets will be a particularly costly strategy. For a typical American family with a household income of $70,000 and $25,000 in savings, keeping that money in traditional savings accounts during 2026 could cost between $2,000 and $4,000 in lost purchasing power. This may seem small, but represents between 3% and 6% of annual family income. It's like losing more than a month's work per year simply by choosing the safest place to keep money. Multiply this by a decade, and you're talking about $30,000 to $50,000 in lost purchasing power. For a middle-class family, this could be the difference between being able to pay for their children's college or not, between retiring at 65 or at 70. Not all savings are equally vulnerable. The most dangerous financial products in 2026 will be traditional savings accounts paying less than 2% per year. With inflation projected between 3% and 5%, the real return will be significantly negative. Long-term CDs with low fixed rates. If you lock money at 3% for 5 years, and average inflation is 4.5%, you'll literally be paying to lend money to the bank in real terms. Long-term government bonds bought at high prices. If interest rates rise, the value of these bonds will fall, creating capital losses beyond inflationary erosion. Life insurance with low-yield investment components. These products often offer even worse returns than savings, with the additional disadvantage of low liquidity. The common pattern among all these products is the promise of safety in exchange for returns that neither keep up with inflation nor economic growth. Now that you understand the problems, let's move to practical solutions. Based on the principles we've discussed and the cycles we're observing, there's a structured approach to protect and grow your wealth in 2026. First, you need an emergency reserve. This is non-negotiable. But the question is, how much and where to keep this reserve. The traditional rule suggests 3 to 6 months of expenses. I suggest a more nuanced approach. Keep 3 months of expenses in high liquidity instruments, checking account, high yield savings, and another 3 months in slightly less liquid instruments, but with better returns, laddered CDs, money market funds, or even short-term high-quality bonds. This ensures you have immediate access to money for real emergencies, but don't keep an excessive amount in instruments that quickly lose purchasing power. For the rest of your wealth, diversification is fundamental, but not the traditional diversification of 60% stocks and 40% bonds. This approach worked well when bonds offered positive real returns, but may not work in the coming years. A more robust approach for 2026 would be something like 30% in high-quality company stocks, focusing on companies that historically manage to pass cost increases to prices, companies with real pricing power. Include both American and international companies, 25% in real assets, real estate in via REITs, commodities, agricultural land, or other tangible assets that tend to maintain value during inflationary periods. 20% in inflation protection instruments, TIPS, Treasury, inflation protected security, I bonds, or other forms of inflation protection provided by the government. 15% in short-term high-quality bonds or laddered CDs for stability and liquidity, but without excessive exposure to interest rate risk. 10% in alternatives. This can include small exposures to precious metals, strong foreign currencies, or even small positions in crypto assets for those with higher risk tolerance. This approach ensures you have exposure to different types of assets that respond differently to various economic scenarios. Having the right allocation is just the first step. The second step, equally important, is to rebalance the portfolio regularly. Establish a simple rule. Rebalance whenever any asset deviates more than 5 percentage points from the target allocation, or at least once a year. This forces you to sell assets that have appreciated too much and buy assets that are relatively cheap. It's a systematic way to apply the principle buy low, sell high without trying to guess market timing. Remember, you're not trying to maximize returns in 2026 specifically. You're trying to preserve and grow wealth over decades. This means you need to be prepared for short-term volatility in exchange for more solid long-term returns. The portfolio I suggested will have years where it loses money. But historically, such a diversified approach significantly outperforms strategies based on safety of low-yield instruments. If you can't sleep at night because your portfolio dropped 10% in a year, you probably have more risk than you should. But if you can accept short-term volatility in exchange for long-term purchasing power preservation, this approach will make sense. We've reached the end of this analysis, but actually, we've reached the beginning of a more important journey. The journey of understanding that true financial security doesn't come from avoiding all risks, but from understanding which risks are worth taking and which risks you're taking without realizing it. The biggest risk in 2026 won't be stock market volatility or real estate price fluctuation. The biggest risk will be complacency, the comfortable but illusory feeling that keeping money in savings accounts or low-yield bonds is a safe strategy. History teaches us that periods of greatest wealth destruction don't happen during dramatic and visible crises. They happen during long periods of silent erosion where people make choices that seem prudent in the short term but are devastating in the long term. If you observe carefully, you'll notice that all major economic cycles follow the same basic pattern. Periods of expansion, where credit grows and people feel confident, followed by periods of contraction, where economic reality forces painful adjustments. We're at the end of an extraordinary expansion cycle that lasted more than a decade. This doesn't mean a collapse is imminent, but it means the strategies that work during expansion may not work during the next phase. During expansions, even mediocre strategies seem to work. During contractions and transitions, only truly solid strategies survive and prosper. The difference between preserved wealth and destroyed wealth usually comes down to understanding this distinction. Preparation for 2026 shouldn't be done with anxiety or haste. It should be done with the patience and discipline that characterize all great long-term investors. Start gradually. If you have 100% of your money in low-yield instruments today, don't try to change it 100% tomorrow. Make the transition over 6 to 12 months, educating yourself in the process and building confidence in the new approach. Remember that you're not trying to time the market. You're building a strategy that works in multiple possible economic scenarios. A robust strategy doesn't depend on making specific predictions correctly. It works even when your predictions are wrong. In the end, money is just a tool. The real goal isn't to accumulate bigger numbers in a bank account. It's to preserve and expand your ability to live the life you want to live. Traditional savings accounts may seem safe because the numbers don't decrease. But if those numbers buy less food, less housing, less education for your children, less health care in your old age, then what's the real value of that safety? True security comes from understanding the fundamental principles that govern money and markets and applying those principles consistently over time. It comes from accepting short-term volatility in exchange for real long-term stability. This isn't a prediction, it's a logical consequence. If you understand how the monetary system works, how economic cycles work, and how long-term investment mathematics works, the conclusion is inevitable. Keeping money in instruments that neither keep up with inflation nor offer exposure to real economic growth is a recipe for gradual impoverishment. In 2026, this logic will be even clearer than it is today. But for those who understand now and act accordingly, 2026 can be the beginning of a decade of true wealth creation. The choice is yours. You can continue doing what everyone does, seeking the apparent safety of instruments that silently lose purchasing power. Or you can understand the principles, accept the implications, and build a strategy that actually protects and grows your wealth over time. History will be the final judge. But if you study enough history, you already know which approach will be validated by time. History is an excellent teacher for those who know how to listen to its lessons.